Good afternoon, ladies and gentlemen. It's Caesar Farfan here. Welcome to the Perennial live webinar for the launch of the Perennial Private to Public Opportunities Fund for wholesale investors only. My apologies for the delay. We had a bit of a technical glitch on this end. We've done literally hundreds of these, but it's Murphy's Law. Today we did have a problem, so my apologies. We'll make sure to make up for that lost time. As I said, I'm Caesar Farfan. I lead the distribution team. With me today, I have my colleagues Andrew Smith and Ryan Son. They'll be talking in due course. Look, at Perennial, we've been investing in the smaller microcap space since 2002. We're managing circa $1.3 billion across small caps and microcaps. The small caps business has now been closed for institutional investors for a little while, and I'll take you through the journey in terms of how we got to this offer. Back in 2017, off the back of some client demand, we decided to launch a dedicated microcap fund. We went back, looked at our performance that we carved out from the small caps portfolio, and realised that there'd been some really solid alpha there. So we launched a dedicated microcap fund just for the wholesale market. We were hoping to close that fund within 3 years. The demand we've had for that fund has exceeded expectations, and we're about to close at 30 June. In consultation with a couple of large clients, we've decided to launch a dedicated unlisted fund now. So the microcap fund has had the ability to invest in the unlisted space, albeit limited at 20%. Obviously, being a fund that has daily unit price and daily liquidity, there's only so much we allocate to this space. In terms of the actual fund itself, the Microcap Opportunities Fund, which is about to close, it's been recognised by the industry with a number of accolades last year and this year. You can see on the screen there, both Unlisted and Zenith, two of the main research houses, have given us the top gong for those respective small cap categories. Zenith have actually have us ranked as the #1 microcap manager in the market. So you basically be talking to a team today that has a very strong track record and a very strong pedigree in investing in this sector. I'll just briefly touch on the offer before I pass on to Andrew Smith. So we're talking about an unlisted wholesale unit trust, which will only be available to wholesale investors. Many of you might be familiar with the definition of a wholesale investor. It's either someone that can invest $500,000 or meet the sophisticated investor rules. There'll be more information in the information memorandum. And if you're not too sure, or you can always speak to your accountant, or feel free to reach out to us. We're looking to raise between $50 and $100 million. The fund is already hasn't officially opened. It'll be opening next week, but we've got a very strong cornerstone investor in Morgan Stanley, who have also been very strong supporters of the Microcap Trust. Briefly touch on the fees. Sorry, the minimum investment is $100,000. The fees, we have a management fee of 1.5%. That'll be charged monthly. That's not too dissimilar to what we charge on our microcap trust at the moment, which is 1.2. There are a few more costs involved in running an unlisted trust. All those costs will be captured within that fee, so there is no extra expense recovery at the trust level. And the performance fee is 20% over a hurdle. The hurdle is 6.5% per annum, compounding. And the way we'll earn that hurdle will basically be in two steps. Firstly, there'll be a performance fee of 10% above the hurdle, which will be calculated and paid annually. So if we outperform that hurdle, we'll pay ourselves 10% every 30 June. In addition to that, there'll be a second deferred 10%, which will be at the end of the life of the fund. So in effect, what will happen at the end of the life of the fund, if we've outperformed the cumulative hurdle and we've generated alpha, we'll calculate the 20% for the period of the investment and deduct the 10% that we've paid ourselves throughout the various years. The fund will distribute annually, so any realized gains that we have will be paid out every year. No redemptions, as it's a 5-year fund. Andrew and Ryan will talk about why it makes sense to be able to lock up your money and take benefit of this illiquidity premium. In terms of service providers, just very briefly, best in breed, mainstream fund administration custodian. Mint Ellison have helped us draft up the offer document, and we've received tax advice from EY. Just moving on to the team now. So I'll shortly pass on to Andrew. Andrew heads up the small companies and microcaps business. He'll be the lead portfolio manager on this new offer. And also with us today is Ryan Son. He's an analyst in the team. He'll be the deputy portfolio manager on this capability. So I'll now pass on to Andrew Smith.
Thanks, Caesar, and thanks everyone for your interest and attendance on the call today. Just coming back to the team, probably worth highlighting that we think we've got one of the largest and most diverse teams in the market. We've got specialists across most industry sectors, from resources, healthcare, agriculture, retail. So the way this fund will work, Ryan and I will sit in every meeting for investment potentials in this fund. But where it's appropriate, we will get the analytical work to be done by the specialist in the team. So, for example, if it's a retail stock or healthcare, Marnie's our specialist in that space. If it's a mining services or West Australian industrial, we've got Sam Berridge based in Western Australia who can run those investments for us. Worth pointing out, though, that this fund will be industrial focused, so we won't be doing resource companies in the first two buckets of this fund. Also really important is how to manage our exit from these investments, given it is a 5-year fund. And we've got a dedicated dealer in Stephen Yee, who's got many years in the market, really good relationships across all brokers. And he's been doing a great job for us in the smaller microcap fund in finding liquidity for us to exit these investments at the appropriate time. Caesar touched on most of the background, but just to summarise from my point of view, when we were managing this, the smaller companies fund since 2002, we noticed that we're making really good alpha in the microcap end of the market. The back testing showed 11% per annum, and really pleasing that we've done better than that since we had a dedicated product. So in the same way that we felt like we're leaving a bit of money on the table for our investors by not having a dedicated microcap product, in the 2 years or over 2 years that we've been running the microcap fund, we felt like the pre-IPO opportunities we're taking advantage of, our position sizes weren't large enough to take full advantage. And that reflects the fact that the micro fund has daily liquidity requirements. So we have to position the pre-IPOs and unlisted expansion capital investments appropriately. What am I saying there is, what might be a 0.7%, less than a percent position in microcaps, that could be a 3 or 4% position in this new fund because we've got the liquidity match with the 5-year lockup. The microcap fund, if you look at the last year, the net returns above the benchmark, a lot of that was fueled by some of the pre-IPO examples, which Ryan and I will run through. I think it's a good indication of the premium you can get for taking on that liquidity risk. The fund's going to focus on 3 areas. The pre-IPO is your more traditional investment where the company is 6 to 12 months away from listing, and we'll run through some worked examples from our microcap fund there. That'll be up to 40% of the portfolio, and that's typically made through a convertible note instrument. So we'll be getting a discount to the ultimate listing price, and typically we'll look for a 25% discount as a minimum plus a coupon, typically 10%. We might have some other limits in there, and Ryan can elaborate further on that. But what the interesting point about that bucket, that 40%, is our investment will move with the market. So if we have a downturn like we had last December, we're getting a discount to the ultimate listing price, and obviously that listing price will come down in that environment. So we haven't come down with the market. We've got a set discount that moves with the market, so we don't take the market cycle risk on that part of the portfolio. The unlisted expansion and growth capital, these are businesses that need some growth capital now, and we think in 2 to 3 years they're going to be a much bigger business and a much better prospect for listing. So we'll typically take an equity position there because we see a lot of upside, and then 2 to 3 years' time that will prepare them for pre-IPO in conjunction with our advisors. In the listed space, this is your more traditional IPOs. So for example, PointsBet was an example from our microcap fund, which listed this month. We made our first investment and only investment at the IPO stage. So this fund will also participate in your traditional IPOs and also any listed placements. So I guess an important differentiator is that it's only new capital and only growth capital that's being raised. We won't be buying anything on market in this fund. I'll now hand over to Ryan to run you through a few examples, and then we'll give you some more detail around those buckets.
Hi everyone, just before I start the examples, I just wanted to point out that there's a Q&A, so feel free to type in your questions and we'll get to them at the very end. So the first example I'll run through is Ecofiber. This is a great example of us taking an unlisted expansion capital position, which we then followed through into the IPO. The reason why we took the unlisted investment and we took straight equity was because we saw this as a company that had exceptional growth prospects and could be worth multiples of what our initial investment was. Just to briefly summarize, Ecofiber is an industrial hemp business. They've got 3 divisions. The first is Ananda Professionals. This is the business that is based in the US. And the best way to think about this is it's sort of the Blackmores of the hemp industry. So they're selling to pharmaceuticals for products such as sleep and anxiety. The second part of the business is Ananda Food. This is based in Australia. And this division sells food products such as hemp protein and hemp oil for cooking. And the third part of the business is Hemp Black. This is a technology business in which they own a patent over the supply chain of getting industrial hemp into textiles. The benefit of this is that hemp has got conductivity, antibacterial, anti-wicking properties. So the use cases there's multiple use cases of this. So due to the fact that we saw this as a company that had great growth prospects, we took that unlisted position at 57 cents, which equated to a market cap of $164 million at the time. We kept this at cost up until the point in which a third-party strategic investor invested into the Hemp Black business at equivalent price of 65 cents. At this point in time, we were able to rewrite our position up to this price. It's important to note that we'll keep our investments carried at cost unless there is a tangible transaction. Finally, we followed our money into the IPO at $1. Ecofiber, they had no broker. They were using no broker to list the company, and the company specifically went down the path of offering the IPO to retail investors. So it was quite tough to get money at an institutional level. However, due to the fact that we'd met the company multiple times, we'd done a site visit, and we'd built up a great relationship with the business, we were able to get quite a significant stake at the IPO. The second example I'll run through is Atomos, and this is a great example of a business in which we invested at the pre-IPO stage. We held a convertible note with a coupon and then converted this at the IPO. Just briefly, Atomos it's a hardware that will sit on top of your video recorder, so your Canons and your Nikons, and it's sort of double the size of your phone. Basically what it does is it takes the raw footage from your video. It has a hard disk behind it, and it's getting extremely high resolution. The benefit of this is that the person who's recording the video can see what they're recording in real time in extremely high resolution on a bigger screen rather than the small screen on the camera. This helps them do, if you want to call it, live editing rather than waiting till the very end of the editing stage, where it can be quite time consuming and also very expensive. So Atomos has got sort of the market dominant position in the semi-pro market. So think of your Red Bull videos where they're 1 to 2 minutes, and they dominate the space. The plan for the company is to expand this out into other verticals such as social, so your YouTubers, and also enterprise. We're able to structure a deal in which it was a convertible note with certain clauses. The first clause was that the company was enticed to list the company in December 2018, or else our discount to the IPO was going to increase. As most of you are aware, this period was quite a tough time for the market, particularly tech companies. However, given the fact that we had a ratchet clause in there with the discount to increase, the company was incentivized to list there. Initially, the company wanted to list at an EV to sales multiple of 3 times. However, given the nature of where the market was at, we suggested to the company that they reprice this down to a more tangible, profitable number, which other investors could sort of hang their models on. Given this pricing, we gave the company a lot of comfort that we would invest and therefore de-risk the IPO process. Suffice to say, the company wasn't initially happy with this. However, they came back to our terms as they felt they could get the IPO away. We've held this company on, and it since has upgraded in May. The third example, which I'll pass on to Andrew, is an example in which we've held it from an unlisted investment through to a pre-IPO and into IPO, and it also shows that it doesn't always go right initially, but we'll add a bit of stealth to we'll add a bit of rigor to the process.
Thanks, Ryan. So just briefly what Unity Wireless does, it's an NBN disruptor. So it's point-to-point wireless. So instead of getting your NBN through the ground, through fiber, you're getting it through the air in a point-to-point. So think about it as a microwave dish on top of your building, pointing to a nearby larger building. So clearly it takes a lot of capital to roll these out as you spread throughout the suburbs. So this was a business that we first met several years ago. The founders at the time were excellent technically, and also were having some really good inroads in terms of customer satisfaction. So the research we did suggested very high customer satisfaction, very little downtime from an internet point of view, and obviously that was the key selling point against the NBN, which still has reliability issues to this day. We liked the fact that this company was pretty small, had a lot of rollout potential. So they had decent presence in Adelaide at the time. They were just starting to expand into Melbourne, and then they had Brisbane and Sydney next on their radar. Several months after investing, we felt the business wasn't being aggressive enough in their rollout. They were actually looking to slow down their plans, which we invested on the basis of. So with the broker that brought the deal to us, we instigated some board changes, got a new chairperson in there. They also brought on a new managing director who's done an excellent job, not only of finding some acquisitions, which on a multiple of 3 times, which is obviously very attractive. So that's boosted the earnings of this business, but he's also cut costs and set the business up nicely to start that aggressive expansion again. So we wrote quite a small initial investment there at 59 cents. And when it came to the IPO and the pre-IPO rounds, we thought it was important that we set the pricing right. Again, it was a tough market coming out of that December tech crash, and we really wanted this to be a successful IPO, and we wanted to invest more money at the IPO on behalf of our investors. And that's probably a good differentiator for us versus other funds. We want to set these businesses up to be excellent IPOs and put more capital in at that point. And that's a key differentiator for us versus other pre-IPO funds. So at that IPO investment, we made a large investment. We went actually up to 15% of the company. We were able to convert our pre-IPO investment, which was in a convertible note form, like Ryan described with Atomos. And that brought our average entry price down to 22 cents. It had a rocky start to listing, but we'd done our homework and we stuck with our position. Since then, you've seen Vaughan Bowen, who's one of the M2's founders. He's come on board. He actually bought stock, has become a director. And in fact, we actually saw today he's also bought more stock, and the stock's gone above $1.40 now. So it's been a very successful investment on behalf of our unit holders in the microcap fund. And what we're showing here is the 3 buckets we've described. So the unlisted expansion, the pre-IPO, and the IPOs and placements. And we're giving you every deal we've done since the microcap fund started. And that's every industrial deal, because as I said, we'll be excluding mining companies from those first 2 buckets where we have to take liquidity risk. The numbers you can see there, and check the footnotes to see the amount of deals that sit behind them. But as you'd expect, on the far right, the IPOs and listed placements, these are the investments that are most are closest to a liquidity event. So in the case of placement, you're only out of market for a number of days. In an IPO, it's a number of weeks. So that they're the most liquid investments, so you would expect the returns to be lower. I would say there that Next Science was been particularly successful IPO, so that does drag up that return. I would expect 10 to 12% would be a reasonable outcome on these investments. Importantly, we are looking to make these investments 2 or 3 times a year. So that bucket will turn over in effect 2 or 3 times a year is the thinking in this fund. Contrast that with the far left-hand side, the unlisted expansion and growth capital. This is the least liquid part of the market and part of our investment, but that's where the largest returns would be to compensate for this risk. So that's where Ecofibre, for example, that's where the investment was made there initially, and same case with Unity Wireless. And as you saw with Unity Wireless, it's possible for these investments to pass through each of these 3 buckets, or in the case of Ecofibre, it skips straight from unlisted expansion straight to IPO. There's some other names up there which we have existing investments in. Importantly, on the left-hand side, they're carried at cost. So out of the 6 deals, only 2 have come to market so far. One of them was going to have a nice uplift at the end of this month, but that return we're showing there just is the average of the 6 deals. 4 of them are held at cost, so a 0% return. Clearly, Ecofibre and Unity Wireless have been very profitable for our investors. And then the middle case, one that hasn't worked so well would be Revison, but the important outcome there is our convertible note discount means that we're close to break even on that investment. And we think that's a matter of timing. With the benefit of hindsight, it probably came to market about a year too early. Now would be a perfect time for Revison to be listing. And certainly that's a lesson we're taking into account into current investments, where we're encouraging companies to stay private for longer to make sure that they're setting themselves up for a very successful IPO. So the structure of these funds, the investment period is quite different. So the unlisted expansion capital will be investing over the first 3 years. In reality, it's likely that most of our investments will be made in the first 2 years of this fund, and the rest of the time we're focusing on realising that investment. So getting to a liquidity event and maximising their exit return for our investors. In the pre-IPO space, we'll be making those investments over the first 4 years, and we're recycling those investments potentially once or every 1.5 years in that pre-IPO bucket. The unlisted expansion capital would expect the average holding period is more like 2 to 3 years. And then, as I mentioned, the IPO and placements, we'll be looking to turn those investments 2 or 3 times a year. What that will do is there'll be any realised gains we make each year will be paid back to investors. So there will be an income stream coming back into the form of distributions. And as we get to the end of year 5, all capital is paid back to the investors. So the benefits we see of this investment asset class is you're able to get into an end of the market which we think is much less competitive. There's 4 or 5 funds that we run into on most deals. Some of our best deals, however, we've actually been the only investor in the case of Ecofibre, the only institutional investor in that pre-IPO round. So compare that to the small cap space where we've got over 50 competitors, or large caps where we've got over 100. We think that sets us up nicely. One thing we've been pleasantly surprised with is the power of the Perennial Value brand. We are seen as long-term, sensible investors. So companies love to have us in early in the pre-IPO stage, and they're happy to take on a pretty heavy discount to get us in the pre-IPO stage. And that's to really de-risk the IPO that's coming down the track. They know that we have a large amount of money in small and micro caps that we can follow and help de-risk their IPOs. So we're seeing a strong benefit from that, and probably better than we expected 2 years ago when we set up the microcap fund. I'll just hand back to Ryan to describe the stage which we invest in and what we look for in a typical investment.
So we're really focused on the expansion and growth stage. So we're not going to take any seed investments or early stage venture capital investments. We're looking for companies that have got $3 to $5 million of revenue, and if they've got a bit of extra capital, then we believe they could grow the business much quicker. Just some key investment characteristics that we look for. The first sort of filter that we use is management. We're looking for strong management that have got deep domain expertise. So in the case of Atomos, the founder was in the camera industry for 10 to 15 years. B, they need to be incredibly passionate people. And also we're looking for management that have done this before and they've had a successful business. Once we're comfortable with management, we're looking into whether or not it's a good product. So in this unlisted part of the universe, you can get a lot of information whether or not the product is selling. So things like, is the revenue per user growing? Is there low churn? What's the net promoter score? So we're looking for product-led businesses. Typically, a lot of these companies don't have any sales staff and the product is selling itself. If they had a few extra salespeople, which with the extra capital, what could they do? That's the question that we ask ourselves. Thirdly, we put on our valuation hat. So we're looking for companies that are at a discount to listed comparables, and we're quite strict on the valuations that we put on. So with your fast-growing software businesses, we're looking for a sort of 3 times EV to sales multiple. With your more typical industrial businesses, we're looking for 1 times, or we're looking at proper cash flow metrics. The other key thing that we look for is we want businesses that are scalable and they've got global potential.
And those multiples Ryan mentioned, they're at least a 50% discount to the listed space. And that's the real driver of the returns, getting that private to public arbitrage on the valuation. So
an interesting anecdote is this year was the first year that there was more private capital put into the market than public capital. So we're seeing an enormous amount of deal flow. Since we've started looking at these companies, we've seen over 250 companies. However, given our process, we're quite picky and we're looking for companies that satisfy our criteria. And that's what we'll continue to do. But we do think that the amount of deal flow that we'll see will continue to increase.
And with that, I'll hand back to Caesar for some concluding remarks. Then we're happy to take any questions that people have on the call. Just log those through your desktop.
Thank you very much, Andrew and Ryan. Just to conclude, we do have a few questions. Basically, we have an exclusive opportunity here to invest into a very attractive asset class with limited competition, also very, very difficult to access. There's also an opportunity to invest alongside a very experienced team. So at Perennial, we've been investing in the smaller microcap end of the market since 2002. And you would have seen from some of the slides before, we have a very strong track record there. Perennial Value has been around since 2000. We manage circa $5.5 billion, and our corporate access is fantastic, and we have some very strong networks out there. We also have a proven track record in negotiating deals and driving that private to public premium, that arbitrage that Andrew mentioned. So we're not novices in this space. We've already been doing that both in our small caps and our microcap fund. The fund does have limited capacity. So we will be opening the fund next week. You'll be receiving a copy of the presentation and also the information memorandum. And we expect to close late July, early August, or earlier depending on demand. So demand so far has been strong, not just from Morgan Stanley, who's our cornerstone, but also from other wealth management groups and direct investors that we've been speaking to. So what I might do now is just open up to a few questions. So I've got one question here, either for Andrew or Ryan. How do you actually value these assets that are unlisted?
So in terms of valuing it in the fund, we'll carry them all at cost. So the price in which we invested in, we'll keep these carried at cost until there is a tangible repricing event. So in the case of Ecofiber, there was another investor that put in an investment at a higher price than ours. We'll do this both ways, up and down. Hopefully they're always up, but you never know. In terms of our own valuations, we do detailed modeling on all our companies. We take a 3-year view. So we're looking for these companies. If they're not profitable right now, are they going to make cash flow in 3 years? And then we use our typical valuation metrics that we use within the microcap fund.
Thank you, Ryan. So basically, either a liquidity event, trade sale, IPO, or revaluation through another capital raising. So in line with best practice.
Yep.
We have another question here. Will the fund be available on platforms, e.g. Macquarie Wrap? I might answer that one, gentlemen. Look, it's on a case-by-case basis. So we know that the platforms, in this case, is Macquarie Wrap. We've also spoken to Hub24 and Netwealth and BT. They can administer this fund. It'll have an APIR code. It'll have monthly unit pricing. So it's just a matter of demand. So if there's interest there, we can certainly get the fund onto Macquarie Wrap and other platforms. I hope that answered your question. I've got another question here, maybe for Ryan. Ryan, you mentioned that you've seen more money being raised in the public markets as opposed to the private rather than the public. But what are sort of the catalysts for this?
I think often companies perhaps may be listing too early. So you're seeing a lot of companies in the past that have listed, maybe $10 to $20 million market cap. They may not even be generating revenue, or they're certainly not generating profits. And this makes it quite tough for these companies to get on the radar of any of sort of decent fund managers. So we're seeing companies grow their businesses in the private domain. There's a lot more access to capital in this space, particularly at that seed and venture capital phases. There is a little bit of a gap in the market from that point to the listing, and that is really where we want to play. So put it in the point where, okay, venture capital may have looked at it. We now want it to really expedite the growth, so it becomes an extremely attractive IPO with typically a larger market caps at the time.
Thank you, Ryan. We've got time for one more question that's just come through. There are a few competitors out there in this marketplace. We've seen obviously the likes of Regal and Altium. What do you think is Perennial's edge?
Well, I think the edge that we've got is having the small and the microcap fund behind it. That carrot to the potential investment companies of participating in the IPO is real and tangible, so that drives good discounts. We've got an excellent deal flow through all the, we've been operating for a long time, lots of great networks. It's not only the brokers themselves, some of our best deals have come out of fund managers and brokers that we know through our networks that have spun out and perhaps doing advisory on the side. That's been some of the best deals, because obviously they're not talking to a large network of people. And that team I spoke about, it does take a lot of work. We're already doing this work for the Microcap Fund across our large analyst base. So I think having that rigor of the discipline and of research is another edge.
Thank you, Andrew. And I think we can squeeze one more question here. We have a question regarding governance at the corporate level. What is Perennial's process in terms of checking and influencing governance?
Yeah, so that's a great question. And at the very first meeting, we're focused on, do we trust management? And often that's gut feel, but also there's obviously lots of background checks that we do to give ourselves comfort. And the number one thing is alignment of interests. So if the management team have a very large equity position, then it helps align interests. We also look for the board. Have we had prior dealings with the board that have been positive? Is there a background that we can see of their business career having delivered returns for shareholders? So we really want those things ticked off really early. Now, the board size itself may be quite small at initial. So you want a very strong leader on that board that can represent our interests. We'll often suggest board members. Now, these are independent of us, but they're people that we've dealt with that we trust to look after all shareholders, not just ours, but all shareholders. So I think that's an important differentiation. And if we do see the company steering away from a path that we think is appropriate for shareholders, we will use our leverage. Our leverage is through our equity ownership, so obviously we can vote down through the board process. But more importantly, it's the brokers and advisors that we use. We can use our leverage with them to influence the company and bring about change. But really, they're the exception. Really, we want to get a great board, great management team at day one, and just back them with extra capital.
I'll just add a couple of points to that. When we're doing our diligence on these companies, there's typically a large amount of information which we can access through the data room. So these companies have got quite in-depth data rooms. Often you can judge the quality of the company on the data room in its own right. And secondly, these are companies in which they're usually products which, there's a lot of consumers that are using them. So we can just go out and ask consumers, if it's a real product, or if they like it. We want to make these companies IPO ready. So if we feel there's better board members that could be in place, which with stronger governance, we would happily get involved and do that as well.
Thanks, Ryan. I won't be saying this is the last question anymore. We've got one more here, but I'm sure we can fit it in. What is the range of enterprise value you typically invest in at the early stages?
Yes, so there's a couple of rules of thumb we have there. I mean, the rough number is around 20 million is low enterprise value as we look at. And what's that driven off? At least 3 million in sales. So there's actually, we need a tangible revenue line so we can actually analyze, what are the margins that we're delivering off this product? Has it got resonance with customers? We won't invest in ideas. So that pretty much drives that EV minimum of 20. There is no upper limit in this fund. We've seen some good opportunities in the several hundreds of millions, which are potentials for this fund. But they're more likely going to be in that range of probably 50 to 150 million is our typical investment. Every now and again, we see a nice investment that's much more mature, that might have a large capital need, so stay private to that point.
Fantastic. Thank you, Andrew. Well, ladies and gentlemen, on that note, we might just wind up. So once again, I thank you very much for dialing in today. Apologies again for the slight delay and the early glitch. Please keep an eye out in your inbox. You will be receiving a copy of the presentation and the investment memorandum as well, so the information memorandum. And also we'll send you a link to the online application process sometime next week. So thank you very much, and all the best for the rest of your day.